I didn't follow the trial closely because, again, it was boring to me. But like all of his so-called executives said, this guy did it. This guy asked me to change the balance sheet 7 times.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Somebody came in fried up today. Wrong side of the bed. Wrong side of the bed.
It's been happening to me a lot recently.
We'll just start ranting.
Nothing happened this week. There's nothing worth talking about in the investing world this week. Making fun of you might be worth it, but that's the only reason I'm here. I don't care about anything that happens.
So here, I'm going to ask you a question. I'm going to send you something right now and ask you a question. Because one of the things that you said was boring this week was you were talking about your boy, Sam. Would you like to call him?
Whoa.
As you like to call him, S. Diggity.
Nobody's boy. Not my boy.
Then why are you calling him S. Diggity? How you on a nickname basis?
If we got to go here, were you surprised at the verdict, or were you surprised that it took the jury 2 hours? The jury 2 hours? Like, this is as obvious as a kid.
Maybe not the verdict specifically, but what I was surprised by was who I thought was on trial and who actually got convicted. Are you seeing this picture I just sent to you?
I saw this online. I think this is a joke. Like, this wasn't actually from the.
All I know is your boy S. Diggity went into that courtroom looking like he looked. And apparently he came out of that courtroom looking like Colin Farrell. Because he not only defrauded the users of billions of dollars, he defrauded the public of those cheekbones.
If you don't know, there's some apparent court drawing of him where he looks like super handsome all of a sudden. And no offense to SBF, but I've never thought he was a particularly handsome dude. So the jokes going around about this drawing in particular were hilarious because it was like, apparently Michael Lewis is doing the art now. It's an extremely flattering picture.
It's more than extremely flattering. It's a different human. Like that, it's a solely different human.
That's why I don't think it's from the actual trial. Like, it can't be.
So I'm going to switch slight gears for a moment here and reach into the fishbowl, but continue on this thread of, I'll call it misbehavior, misgivings. And this is not directly investing related. Sometimes things that we talk about are not, but I do have a little bit of an investing spin on this. And it goes back to a conversation we had a few weeks ago that I'd like to talk about. So what I'm a jibba-jab about right now is this New York Times piece called Kanye and Adidas, Money, Misconduct, and the Price of Appeasement. Megan Toohey, I'll put this out there, credit where credit is due. And what they did was they went back and went through treasure troves of text messages, talked to former Adidas employees, talked to former Kanye West employees to get the scoop on what the daily be at with the Adidas and Kanye relationship. Headline basically here is Adidas came out at the end and said, look, over the past few weeks, whatever the time period was that they were talking about, but it was something like that short, it's become apparent to us that Kanye has been jibby-jabbing too much about things that do not reflect our values. We're cutting ties. However, if you go back to the start of the relationship, that same behavior or very similar behavior had existed, according to this piece.
Yeah.
That's what the whole piece is about. I'm going to give a couple examples, and then I want to give you where the investing flavor of this comes from for me, and when I want to have a little conversation about that. So we can talk about Ye if you want, or we can talk about the investing piece or.
We're going to talk about Ye for just a little bit. Here's my favorite quote from Ye. And you're scared over there because this could go a lot of ways.
Yeah,
you don't know.
Hold on. When you say, here's my favorite quote from Ye, yes, it is frightening. Go ahead. This is a clean podcast.
Yeah, here we go. If you want these crazy ideas and this crazy music and this crazy way of thinking, there's a chance it might come from a crazy person. Kanye West.
That's legit. That's it. And that's real.
And that, I think, is going to be a nice lead in to the topic from this article, because I think that's kind of what he's made some brilliant stuff he's a very creative mind. I kind of think Adidas knew all along what they were working with here.
That's what this whole piece is
Yeah,
about.
right.
And the examples, I'm just going to drop a few because this is a long article. We'll have it on the Substack on Monday. This is a long article. Going back to the beginning, per what you were just saying there. So Kanye West, according to this, goes and meets with folks at Adidas to look at some of their like inspirations, what they wanted to lay out as inspiration for shoe designs. They have this mood board. Who knows what the heck was on that? But they had this mood board, and they had a bunch of like fabrics and shoes. Kanye said he was offended by some of the selections they made. And he was so offended that what he then went to go do, according to this, was he drew a swastika on the front of a shoe.
No.
This was in 2013 at the first meeting that they had. So when you start talking about, a year ago, they cut ties, and that's when a lot of at least from the Adidas perspective, when they started acknowledging his anti-Semitic like comments and whatnot, it back to the get from this. Also, just weeks, according to this, before the 2013 swastika incident, the Times found Mr. West made Adidas executives watch pornography during a meeting at his Manhattan apartment, ostensibly to spark creativity.
Not so great.
Yeah. Okay. Yes. Understand. Yes. I mean, that is actually the perfect retort here. No, exactly. This is the whole thing, and it was after this that sales were going so well, and this is what happens. This is what I really want to talk about, because this is one of those things that happens. Adidas at this point in time had about, I think they said 8% of the athletic shoe market. I don't know if it was global in the US, but either one doesn't matter. And then Nike was closer to 50. And Adidas is like, we got to catch up. Ye was a way that some of the more like push the boundaries executives saw as a way to do that. It was, from a sales perspective, it was working. They started to build up a lot of sales, making a lot of money. The second contract they made with him had a $10 million guarantee on this. He was getting 15% of sales. And so they were doubling down on their investment. Here's the conversation I want to have that relates to investing. Is a few weeks ago, there was a certain stock that I was talking to you about. And I was like, I don't know how I feel about having my money invested in this stock anymore because of certain behaviors that the company had. And I think it's an interesting conversation. The parallel I'm making here, it's a little bit different, but the parallel here is in business. Let's ignore the reputational risk, because that's different in this case. But let's ignore the reputational risk and just say, even if no one ever found out about this stuff, as a person in business, where do you draw the line of who you're working with? As an investor, where do you draw the line and who you're giving your money to in order for them to continue with their desired goals and behaviors and business practices? That's what I'd love to have a little short conversation about.
That's a minefield, man. Setting me up to stick my foot in my mouth. Here's how I'd answer it. I think there are people who are equally crazy that aren't famous, that lead creative works at the biggest and most popular companies all over the world that don't make headlines. And so the reason I read that Kanye quote is because there's a lot of truth to that. And a lot of the creative types that are pushing the boundaries are a little crazy. And so I'll tell you, from an outsider's perspective, you and I both like shoes. I'm not really an Adidas guy. I certainly have some, but it felt like the street credibility of Adidas in the Ye branding years went up exponentially.
Yeah,
I
absolutely.
understand why the execs liked his designs.
Absolutely. And the thing is, you're talking about feet and mouths. The thing is that it's not as straightforward as sometimes people can draw the line. It feels like it could be straightforward sometimes, but you can take what was it, maybe 2, 3, 4 years ago, somewhat recently, when Roseanne Barr Arnold, I don't know what her name was at the end of her. Yeah. Roseanne came on to Twitter and made a comment about Valerie Jarrett, which was not favorable by any means. It was a bad comment about Valerie Jarrett. It was a joke, but yet and still too much. Now, She got cut from her own show as a result of that. And the question that I kind of raise from this is I go, if she came out on Twitter and put that joke out there, do you think this was the first time that like she's said something like that? I doubt it.
No.
I doubt it.
Yeah.
And so that draws, then the line becomes, is it that you're not working with that person, or is it that someone else found out? And so that's one question. Another thing on the investing side, I'd say, is if I was like, you know what? No, I do not want my money to be in this company. So take my money out. Instead, I'm going to put it in the S&P 500. Oh, guess what? This company's in the S&P 500.
Plenty of them.
Yeah. So
run by
am I going to be
crazy
like,
people.
am I going to be like, you know what? Actually, no, I'm going to create my own index and I'm going to invest in the S&P 499 instead. So like, where do you draw the line? I think it is fascinating with this stuff. And some things I think some people can be like, look, it goes too far. And when we see it goes too far, you pull it. But then that line is not as easy to find as other people think. I think it's an interesting topic and concept for folks.
Yeah, I completely agree. I'll tell you that I now own my own business, and one of the best parts of owning your own business is you can decide who you want to work with on your terms. That's a huge benefit that I think people overlook. You can actually put your money where your mouth with it in a lot of ways. In terms of your concrete example of, do I want the S&P? It wouldn't even be 499, Doogles. It'd be
the S&P 6.
450. I mean, it'd be something. I don't think that energy and effort is efficient, which goes into an entirely different place where I don't think you wanted to go. But I also don't believe that investing in a company's future cash flows is giving them carte blanche to say that you approve of every decision they've ever made. I just disconnect. It's a financial decision. It doesn't mean you fully support their values, if you want to put it that way, because it can't. It's too, you can get stuck digging an endless hole if you want to look at the morals and values of every company you ever invest in.
Or every person in every company you're invested in. Because to your point, it's also, let's say you invest in a company and future cash flows, and then the CEO changes in either direction, right? What you're saying is, I'm investing in the future cash flows of this business, but executives can change in and out. And really what we're talking about is people and the behaviors of people, not the behaviors of companies. So it's I think it's an interesting thing for folks to think about. I know people will fall on various sides of that line, but when I was reading this piece, it's like, oh my goodness, it's really fascinating. And going back to your owning your own business point, there is the two things. One, yes, you get to make those decisions, and two, you, from what you've stated very clearly, are not like trying to build a multi-billion-dollar organization. You don't have interest in that. And so along those lines, it's different when you're like, actually, I can choose whatever the 5 clients are that I want to work with versus, okay, now I have 20,000 clients and I need to get to 30,000 clients. And so how do the denominator starts to go down.
It's a great point, but those things, you're saying those things are linked. Those things are more linked than I think the large majority of people realize. One of the reasons I've decided not to make the next Fortune 500 company is because I want more control over that.
Yeah.
And also, like, to get in the nerd finance land, having more control over that allows you to pick clients that have a more ideal profile for you, which ultimately leads to increased profitability if you do it right. There are some huge advantages to staying small.
Choice.
You mentioned that you never know who's going to run a company, or like you could have invested with one CEO and then that person changes or the board changes. There's a company called InMode Limited. It's on the NASDAQ. Ticker is INMD. Did I send you this?
You did not. No.
Their CEO this week went on the record, and I'm going to just summarize because it's long, and effectively said, we talked about buybacks a bunch. Last time we spent 100 million on the stock, the stock price didn't change. It actually went down. So we're not doing buybacks again. His whole entire thought process, which is so telling, is we were buying stock to keep the stock price up. And what you can read between the lines on that is he gets stock-based compensation or he owns a lot of equity and he wants that equity to be with a certain price. Where I lost my mind, and so did other people in the financial community, is as a CEO, what is your most important job? It's typically capital allocation. This dude doesn't appear to know. He doesn't appear to know that he should know what the true intrinsic value of his stock is. And if it's below that, especially significantly below that, he should be buying back stock regardless of what is happening to the stock price because it's good for him and his company. That disconnect just floored me. And I don't even want to mention the name. Like it just, we can talk about it hypothetically.
Yeah, I know that these are, if this will sound a bit different, and maybe it is a bit different, but along the same, I think it's the same vein of what you're saying here, is I can't imagine if you came to me and you're like, you got to look at this stock, Winnebago Industries. Like, oh, interesting. Tell me more about it. And you said, you have to buy this stock because if you buy this stock, the price will increase.
That's the perfect example.
It's like, okay. Like it's not that the valuation is under, as you were saying, intrinsic value. It's just you buy it so the price goes up. It's just a weird capital allocation decision.
I gotta just continue to hammer on that. So we find a stock, Doogles over there in our hypothetical land is worth $100 billion, right? And we find a stock that only has a market cap of $1 billion. And I just come to you and I go, dude, if you spend $5 billion on this, I can guarantee you the stock price is going to go up. It's going to be great. And you're like, look, I'm a genius over here. You just effectively overpaid for the company by 5 times. I mean, I cannot imagine. Let me just give you the market cap of this. This company in mode is effectively a $2 billion company based on current market cap. I can't imagine leading a $2 billion company and seemingly, and maybe I'm being harsh to the CEO because I don't have the full context. I didn't actually listen to the transcript, but seemingly not understanding that it's about the true value of an investment you make rather than just, I'm writing a check in hopes that things go up.
Yeah, it's messed up. And that person should not be running that company. Flat out. I'll just say it. Based on what you just said. I'm not blaming that on you. I'm saying based on those, like that one piece of context. I don't know the full context either. Can I switch to something else you said was boring?
Absolutely.
But it's a cousin of something else you said was boring. So Charlie Munger was all up on the news this week. And by all up on the news, I mean there was a Wall Street Journal piece and an acquired podcast. But Charlie Munger is 99 years old. That's a lot of activity. I think they might have been a part of the same conversation, but yet and still. I want to pull a few things from the Wall Street Journal Q&A, if that's okay with you. You said it was
Please.
boring.
Yeah.
And most times, Charlie's not saying something that's brand new, but Charlie's words are so straightforward. I find them to be interesting and many times, and a lot of lessons to glean from that 99 years. One thing that was asked of Charlie by the Wall Street Journal was they said, if you could go back to 1950s and start your investing career over again, would you do anything differently? By the way, in none of these questions, I think that he answered the question. But like
he just talks. Yeah. But this is actually the one not boring thing that he said this week.
Yeah. And so he said times have changed. He said a bunch of stuff that was basically times have changed. And then he says this. I think that the modern investor, to get ahead, almost has to get in a few stocks that are way above average. They try and have a few Apples or Googles or so on just to keep up, because they know that a significant percentage of all the gains that come to all the common stockholders combined is going to come from a few of these super competitors. He says this after, as I mentioned, he says times have changed. He said back in the day, there was low-hanging fruit. If you have the brain of Warren Buffett and Charlie Munger, right, and that style, the Ben Graham style, he said there was like low-hanging fruit, and he said the low-hanging fruit has gone away. And that's what he said right before he dropped this.
Well, he also said, I swear I'm getting there to the answer. He also said he doesn't anticipate them selling Apple like anytime soon, which is saying the same thing. And I think this entire talking point ties back to Buffett being reluctant to buy a so-called technology name. Like there was the longest time in the early 2010s where he hadn't really dipped his toe in Apple or Google or Facebook or anything else. I'm absolutely shocked he didn't buy Meta when it was in its lows last year, because it just got so cheap that I thought he'd buy it based on the same logic of like, there are certain companies, the way the US tech sector is structured, that you have to own because they just make up such a large percentage of commerce.
Yep.
But this is funny because I slightly disagree with him on this take. We are in a bull run for growth stocks that's lasted 13 years, effectively since 2008, 2009. And things like small value stocks and emerging market economies, we've covered this ad nauseum, are at their basically their cheapest metrics historically when you look at trends against value stocks to growth stocks, or price to book, price to earnings, price to cash flow metrics on those certain things. So yes, in the last 13 or 14 years, you had to own an Apple or a Google or a Nvidia or something like that, or Tesla, to get ahead. But to me, that's just an anomaly where we've been in a crazy cycle. I think it's a really exciting time to not own those stocks because they all are fairly expensive.
I take a slightly different view on that too. It's not against what you just said, but when you have $500 billion at your disposal, the mindset that Charlie Munger no longer, maybe he can put himself in these shoes, but I would bet no longer put himself in the shoes of the person that has, I don't know, $1,000 and trying to figure out what to do with it.
Yeah.
Right. When you have $500 billion, which is roughly where they are, they have about $350 billion in their stock portfolio and $150 billion in cash. To move the needle on that, to find investments that you can put that much cash into that are going to shift your portfolio, it makes more sense to look at large cap, like mega cap companies. But for the common stockholder, like your everyday person, yeah, I think there's the indexes is what we talk about generally, but I think you can probably, I don't know, this, I think it's not a great mindset probably for most people to have, but I found it to be interesting coming out of his face.
Yes. So you're actually going to bring up two other points that tie to this. So on the Munger interview with the Acquired podcast, they asked something similar. It's a similar talking point, and I'll paraphrase. And he talks about how much harder it is today. And they ask him, like, if he'd be able to have the same returns. Correct me here, because I don't think I'm going to get it entirely right. And well, that, and if he'd start again.
Yep.
And he kind of says like it's a losing game now, right?
For the most part, it's hard. Yeah.
Much harder.
Yeah.
And I think that's incredibly true. But at the same point, I also think, and this is where my memory's failing me a little bit, that he still says like, I'm just naturally wired to try.
Yeah,
and so
exactly.
Even if it was harder, like I probably wouldn't end up with the same wealth, but this is still what I do.
And he still finds it to be so fascinating, the amount of diversity that you can get into in this world. Yeah, I think that was interesting. He another thing he said on the tech front was that he would not break up the big tech companies. And I like this line. I think capitalism should expect to get a few big winners by accident.
Completely.
Yeah. And that's going to be an interesting place to see like where it goes to with all of the what are they called, the five horsemen, whatever those big, like the Apple, Google, Amazon, Microsoft, some other company, Shoe Carnival, like those big companies. I couldn't think of another.
Shoe Carnival's up big this week. We are eating steak this week in my house. Shoe Carnival knocking socks off. It's so great.
We are eating steak this week.
Winnebago too. It's just been a great week. My other point that's slightly related, I don't know if you're able to consume this. Morgan Housel was on with Tim Ferriss.
Oh, no, I didn't see that.
Yeah, and one of the things Morgan mentioned there, wide-ranging conversation, is that he basically just grew up idolizing and loving Buffett, and it hasn't been, and Munger, it hasn't been until recently that he realized all the sacrifices they've made. And the Buffett example is the simplest one. Like, Buffett has valued nothing more than investing since he was 11 years old at the cost of his family, his kids, his hobbies, everything. And that's where I am with. I still respect them ridiculously, but that's where I am with both Buffett and Munger. Their end game is not my preferred end game, not at all. They're super smart, great investors, but holistically, that's not what I'm trying to be.
Where I find it to be always valuable to gain lessons and principles and whatnot from folks like that, but to emulate, no interest. But you can see some of the things they do and see how it applies to your own life. But I agree with that. And you've said that plenty of times. And it also goes back to the Morgan Housel piece around the what he called it, like what it takes to get rich, right, or whatever that we talked about. But it's really about how hard it is when you are. I fully agree. What else you got?
Well, I don't know that we tied up the bow on Sam Bankman-Fried.
Oh, okay.
I
mean, you better put a bow on that. You see them abs?
He was guilty. He was obviously guilty. I didn't follow the trial closely because, again, it was boring to me. But like all of his so-called executives said, this guy did it. This guy asked me to change the balance sheet 7 times. Was there any surprise? I mean, I don't know. I still think the Michael Lewis, maybe this is all I have to get off my chest. I think the Michael Lewis book was fascinating, and I found some of his points persuasive. He never, to me, was like not guilty. He was like, it's more complex than you realize. And the bankruptcy attorneys have motivation here. The Ray J dude, what's the bankruptcy guy?
Ray J? Like it's like Kim Kardashian's former lover.
Anyway, he says it's more complex, but like he's guilty as could be when it comes to effectively, even if you aren't nefariously losing billions of dollars, if you're losing billions of dollars of customer funds, that's called fraud anywhere in the world, not just in America. And you go to jail. So he got 100+ years, right? Or it's formal sentencing isn't there, but it's effectively that's what he will get, correct?
It's the rest of his life.
Yeah.
Who knows when all the deals are done and good behavior. I don't know how all that stuff, like what he ends up serving in the end, but yeah, that's what it looks like. And I wonder what is going through his mind right now. Because he seems like, I don't know, it seems like a thing where probably injustice has been served.
You really think?
In his mind?
No, I don't think so.
You think this is justice in his mind?
I mean, I think like I said, I think it's way more complex and there's more gray area than like your layman might believe. But at the end of the day, it doesn't matter how. Doogles, if you gave me whatever, $200,000 and I like misplaced it because I thought some Shoe Carnival and some Kohl's were hot stocks, that's still fraud.
Oh yeah, I'm not saying that it's injustice. I'm saying in his head, do you think he believed he was doing something wrong while he was doing this? I don't know. Maybe that's a question.
No. We'll just put a bow on it. No, I don't think he believed he was doing something wrong as he did it. I think anyone with a brain in retrospect looks back at what actions were actually taken and says, sorry, you just can't do that. And that's why when I talked through the Michael Lewis book, I talked about how he was trained in Wall Street and how he lost the 300 million and there was no ramifications of that. Like based on his history, I can understand why he thought this was normal, but it's not normal.
No. Wild. And the guy obviously had some kind of talent or has some kind of talent. It's kind of like it's very different talent, but whatever, I can't remember the guy's name, but the Fire Festival guy, you were incredibly good at marketing and sales. Like, could you just go market and sell something like Adidas? Just like go to Adidas and sell more shoes. Corrupt.
Yeah.
Why do you have to?
Okay. Well, so if we're going to go to, we're talking frauds. Sounds like WeWork is going bankrupt this next week, Doogles.
That's what it seems like.
Do we think Adam Newman should buy it back?
Somebody sent me this week. I thought this was wonderful. Adam Newman. So now he has this company Flow.
Yeah.
And Adam Newman says the need for community has never been greater. As his last community startup is filing for bankruptcy.
Well, it's creating a need. This is brilliant marketing on his behalf.
Yeah. I mean, he's starting a real estate company. He might as well buy the real estate of his last company. I see no issue with it. Adam, if you need another check, let me know.
Well, to be fair, WeWork owns basically no real estate, which is one of the problems.
Yeah, yes, that is true.
I mean, if they would have bought back in 2007 highly desirable properties in highly desirable neighborhoods at highly desirable interest rates, it's possible they'd still have a company today, even with all the other nonsense.
I see a couple things that might have been wrong. That was one of them. I think when asked what business are you in, and the answer is improving the world's consciousness, that might have been another potential problem. Another problem is that in their pitch deck, they had a hypothetical illustration of EBITDA, which was a straight up asking a 3-year-old to just draw a line on a graph. It's one of the greatest charts I think I've ever seen. This business was not a business. It was the primary issue, it seems.
I I love your strategy today because I told you I wasn't interested in anything, and you're just over here poking me. Um, so this goes back to FTX and Sam Bankman-Fried. Did you see the Sequoia guys being like, "Yeah, our due diligence really is. We figured this out 18 months ago. This was definitely a fraud." Guys, as a venture capitalist, your job with due diligence is to do it before you write the check, not once the prosecutors come in and take over receivership of this company. Seems very wise to just remain silent about this. We all make mistakes in life. This was clearly a mistake, but don't come out trying to brag about your due diligence with this horrible investment you made.
Well, they might have listened to that. I think it was Stan Druckenmiller, I believe, that was saying that sometimes when he sees an investment idea, he invests and then goes and does the research. Maybe they heard that and they just took it to that next level.
Yeah, just invest and then never do the research.
Yeah, and just never. There's this a 2-step process. No, you're right though. And it's part of probably this, what you were mentioning earlier, around this last period of time where when things get so late 90s too, when things get so irrationally exuberant, to use that phrase, due diligence can become, it's not for everyone, but can become more of like a checkbox than a real thing. And folks are saying like, we have to get in this. And then people are likely more, I don't know if this is Sequoia, but you're more likely to use someone else's investment as your due diligence. It's like, well, Terry said it was good. And I like Terry's, really good. So like, we'll get in there. Anyway.
What's in your fishbowl?
There was something I want to talk about, but I don't know if there is anything to talk about it, but I always find James McIntosh's pieces to be interesting. And he put out this piece in the Wall Street Journal this week that's saying that in the long term, investing is all about the economy. The point of it is that when you look at the various pieces of news that people are reacting to right now, it comes back to yields and the impact of yields on stock prices, or like interest in the stock market. And he said yields are about the economy. Like, you might look at what the Federal Reserve is doing. The Federal Reserve is making its decisions based on data about the economy, right? And so I think he always just has these interesting takes on what's going on. The two things that I found most interesting in this piece weren't even the words necessarily, but there were a couple graphs that I've seen versions of these plenty of times, but for some reason really struck me. So he has this one graph. It goes from, looks like about 1950 to now, and it's treasuries as a percentage of GDP. And if you go back to that time period, so you're looking at right after World War II.
Yes. And
roughly 115% of GDP by eyeing this graph is where we were. And we're currently a little bit above 100, but we were at that same place, if not a little bit higher, not too long ago. So we're effectively at war. It's like, as far as that's concerned, I was like, that is super fascinating to me.
I mean, your joke there is, unfortunately, it just makes me sad. From a simple finance perspective, this is depressing because in times of economic boom, what a government is supposed to do is run a budget surplus, or at least balance the budget, and build a foundation for times of war or Great Depression. And your joke worked 24 months ago, Doogles. It doesn't work anymore because effectively America is at war without our own troops and without our own people in two
Yeah.
different spots.
Yeah.
It's a slippery slope, man.
It's a fragile place. So if someone wanted to, I don't want to take this down the political realm or geopolitical realm, but if someone wanted to poke the bear, this is the time to poke the bear.
No, we're going to go there for just 1 minute. The time to poke the bear is like 3 to 5 years from now. If these conflicts continue, if our politicians don't ever tighten the belt, you could get to the point where printing money to finance whatever the whim of whatever president and congressional leadership is in place doesn't really work anymore. And that's a scary place to be.
The second graph that I found, it's very similar. It came right after the other graph in this piece, is showing the 10-year treasury yield along that same period of time. And I mean, this looks like the stock chart of GM. Basically, it took this huge leap from in the, post World War II, you're talking about 2.5% roughly. And then it gets up above 15% in 1980, and then came all the way back down, as we've talked about before, and now has spiked up from like 0% now up to 5%. Looking at these, I think, is for people that are interested in this, looking at these two graphs, I think is an important reminder as to where we are. And when we've talked about normalcy, like what is normal, I think it's important to look at these two graphs. So those are the two things I pulled away, but I always find James McIntosh's pieces to be interesting and thought-provoking.
He's such an impressive thinker, and we've had him on the show before because of that. Douglas, you're right. I've never seen these graphs this way, directly adjacent to each other.
Yeah.
And it shows what appears to be a clear correlation between the percentage of treasuries as a percentage of GDP versus yields. It's just fascinating.
Yeah.
I mean, I never really thought about those things being as intertwined as they appear to be.
So we'll put this out on the Substack on Monday. Y'all can take a gander. It's good stuff.
Well, so you mentioned Druckenmiller. I don't really want to go there, but do you?
Let's do it.
I didn't get a chance to do a deep dive. He was at the Robin Hood conference, I think in New York City. And he continues to be very critical of the Fed, and in this case, Janet Yellen. I just thought that was interesting.
Yeah.
Like, did this pique your interest at all?
Yeah. Not to your point, not at the deep level, but it did. And it was so aggressive. I didn't expect it. Is mostly where it piqued my interest.
So that's exactly what happened from afar for me. And this is why it's great to have, someone like you to talk through a reaction to this, because a year ago or so, he was at USC's Marshall Business School and gave a high-level presentation talking about his concerns about government debt, which I think are really valid, including his concerns about Medicare, Medicaid, Social Security spending, etc. This one from afar seemed kind of like old man yelling at the grass for growing or something. And I think I really need to do a deep dive and dig in, because maybe this is just one of those where the headlines are deceiving. But one of the criticisms was about for Janet Yellen not refinancing debt during periods of low interest rates. Again, I need to learn more. I didn't really think we had the ability to do that. I thought she kind of had a mandate based on the current budget to issue different maturities, like different treasury maturities, based on the mandate she gets from our governmental leaders, rather than thinking of this as like a business that she runs and is all about optimizing the way her debt is structured. Am I crazy there? How much flexibility does someone like Janet Yellen have to run the government with a business mindset and really think about capital allocation? And how much are they just taking orders from what our political leaders say?
I don't know how it works exactly, so I can't comment on that. But I think it's what I wonder about this is how much is, well, one, how much is what he's saying true? Let's just say, I don't mean factual necessarily, but just was this the biggest blunder? Right? Did she have the power? I think that's one thing. Even if it is the biggest blunder, I then come back to this question of is it the biggest blunder in hindsight or at the time? Because I could see where, let's say Janet Yellen has the power. If Janet Yellen goes, you know what? So Janet Yellen was the Federal Reserve Chair from 2014 to 2018, 4 years. And if Janet Yellen said in 6 years, there's going to be a global pandemic, we're going to have to release like a whole lot of money, cash, and interest rates are going to continue to be low for a while, I think she might be like, yeah, you know what I should do is right now I should make sure that ...
Yeah.
But at the time, I don't know if that period necessarily, it would have been different if Janet Yellen were Federal Reserve Chair from like 2010 to 2020. I think you can put maybe a lot more blame in there, but I don't know. I think he might be right in that something different should have been done then, because yes, for a long period of time, we messed things up. Is that on Janet Yellen at that particular time? I don't know.
Well, here's a headline just so we connect all the dots for the listeners. Stanley Druckenmiller criticizes Janet Yellen for not locking in long-term interest rates, calls it the biggest blunder in Treasury history. You're right that there were multiple people in that seat that could have taken advantage of the same thing, including Munchin under Trump. So I guess with my history and watching U.S. Treasury, have just never really seen someone take a strategic approach on that. Now, I've been plenty critical of the bank Treasury managers locking in really low interest rates at long terms to try and make an extra 5 basis points because you were at historically low rates. It doesn't make any sense. So I think you can be equally as critical of the Treasury for that, assuming they actually have the power to do something about it. But I don't think anyone's ever thought about the role that way in recent history. I mean, who knows? In the 1800s, someone might have done something like that. But it's fascinating. To me, the more important point is if the role evolves into one where you're making capital allocation decisions, I'd call it. And in a way, that's a little scary to me because you'd be trusting one person to almost lead the U.S. government as if it's a company. And it seems like that one person then has a lot of power if they guess poorly about the direction of interest rates.
Oh, yeah. I mean, our whole government structure is built around checks and balances. So that doesn't, because you could say that person's the president, but there's a reason that you have an independent Federal Reserve and, and whatnot. So that would be quite a scary thing. So I don't know. I think I will. I didn't watch the actual video. So I think I will go and watch a bit of the interview to get more info there. But I thought the headline was interesting in this piece. I thought had some points that shocked me. So, and how strong they were.
I think here's what I'll say. If anyone of the listeners knows a market historian who could give us all the facts on what the Fed is able to do and maybe some historic examples, I'd love to talk to that person because it could be a really fascinating discussion. Yeah.
Cool. That a wrap?
That's a wrap.
Thank you, everybody. Appreciate you listening. Please rate and review the podcast. We love listener mail. Please, so you can send that over to skippydoogles@gmail.com. Appreciate you.